I'm a dividend investor, so I invest in stocks for the passive income they generate in the form of dividends. Investing in stocks and receiving the dividends is one way to diversify your income so that you're not solely dependent on your job for your living expenses. And ultimately, my goal is to fire that short for financial independence, retire early, so that I wouldn't have to work for the money. Today I'll share with you guys my top 5 US dividend paying stocks, which I will hold on to forever and let the dividends roll in. Stay tuned. Hi everyone, how's it going? My name is Kalle, welcome to my channel, which is about luxury and finances. So I do enjoy nice things and I share them with you guys, but at the same time I'm all about financial responsibility. So I also talk about the money behind the purchases and how you can build financial security, something that should be our number one priority, not an expensive Louis Vuitton bag. At the end of the day, I believe true luxury is freedom, something that financial security affords. But without further ado, let's talk about the stocks. Obviously, this list is not set in stone and might change over time, but currently these are what I would consider my top dividend picks. And obviously, this type of video comes with a disclaimer, so I am not recommending any stocks. I am merely telling you what I'm personally doing, financially speaking. This video is not investment advice, it is not financial advice, it is educational and entertainment. If you decide to invest in anything, it is always at your own risk and peril. You are 100% responsible for your own investment decisions. My criteria, which I'm not going to technically explain in this video, for choosing dividend stocks are the dividend yield, the quality of the dividend, for example, if the company is a dividend aristocrat or king, and also the payout ratio, the PE ratio, and it must be an established company with a history of profitable business both in good and bad times. In other words, I'm looking at quality blue chips and value stocks as opposed to growth stocks. Alright, number 1 is Procter & Gamble. This is a consumer staples giant with multiple household brands such as Fairy, Gillette, Head & Shoulders, Swiffer, Oral-B, to name a few. People will always have to do the dishes, for example, so it's a very defensive company as opposed to cyclical. A bad economy won't really impact their business. P&G comes with a current dividend yield of 2+%, which is not huge, but is typical of many quality, reliable, established companies. P&G is also a dividend king, meaning it has increased its dividend for more than 50 years in a row. In view of the PE ratio, the P&G stock is not cheap. I remember a few years ago when the stock was in the $70 range. In other words, it was on sale and I didn't add to my position, which in hindsight I should have done. But anyway, my mean purchase price for my P&G stocks is in the $80 range. Number 2 is not as established as P&G, nor is it a global company. It is Omega Healthcare Investors. Now, Omega is a REIT or REIT, real estate investment trust, which comes with a different set of rules and regulations than regular companies such as P&G. The business of Omega is leasing long-term healthcare facilities, and it operates both in the USA and in the UK. I first learned about Omega several years ago when I talked about high dividend yield companies with my bank counselor. In effect, the current dividend yield of Omega is nearly 9%, which is exceptionally high and might be considered a red flag in terms of the sustainability of the dividend and the long-term prospects of the company. However, I have owned the company for several years and have regularly added to my position and have consistently received superior dividends. What's more, the stock is not expensive with a PE ratio of about 16, which might indicate it is on sale. Of course, there are reasons why investors are not willing to pay more for a share of the company, but I believe in the long-term viability of Omega and will continue to add to my position, as I did just a couple of weeks ago. Number 3 is a pharmaceutical giant whose dividend yield is very tempting, namely AbbVie, which has existed as an independent company since 2013 when it was spun off from Abbott Laboratories. Abbott Laboratories is a dividend aristocrat, meaning it has raised its dividend for at least 25 years, and as a spin-off, AbbVie is considered one too. I started buying AbbVie a few years ago for the dividend, which is currently more than 4%, and with the current market downturn, the dividend yield might go even higher if the stock price falls. The stock price has about doubled in just a few years. I started buying AbbVie when the stock price was in the 70s, and now I regret a little why I didn't buy more at the time, but that kind of wisdom is useless, and in the future I will try to add to my position should there be a further dip. The current PE ratio of AbbVie indicates that the stock is somewhat expensive, but apparently the company has good prospects and several viable drugs in the market, so I am confident about AbbVie as far as I've read about it. Number 4 is a stock about which some have said that it's more like putting money into a bond than investing in the stock market. In effect, the Coca-Cola company has an impressive history of growing dividends despite some occasional headwinds in the beverage industry. Coca-Cola is one of the most valuable global brands, and I believe the beverage will exist forever. This is one of my core stocks, which I believe I will never sell and just let the dividends roll in. That said, I don't think I will add to my position because the Coca-Cola company is one of my biggest positions in my portfolio. The current dividend yield is a bit less than 3%, which is not huge, but these quality blue chips often come with a fairly modest but reliable dividend yield. And with the present market dip, the PE ratio is about 30, which might indicate that the stock is expensive, but then again, these quality companies are rarely at a discount, even in turbulent market conditions. Finally, number 5 is perhaps my favorite stock of all, namely Johnson & Johnson. Johnson & Johnson is a pharmaceutical giant, one of the major medicine companies in the world, but it is also a consumer staples manufacturer such as this hand cream and the dental floss. And Johnson & Johnson also makes medical devices. The company is over 100 years old. It was founded in 1886. And the current dividend yield is between 2 and 3%, which again is not huge, but Johnson & Johnson is a dividend king. It has raised its dividend for more than 50 years, and the dividend is reliable and it is expected to grow into the future. What's more, the current share price is not that high, with a PE ratio of about 25, considering it is a quality company. In effect, some have said that J&J is currently at a discount with such a low PE ratio for a blue chip. Anyway, my mean purchase price for my J&J shares is in the $90 range, and I'm not planning to buy more because it is the second biggest position in my portfolio, so I will just enjoy the quarterly dividends. So to me, dividend comes first. I am not in the stock market in order to sell at a profit. I buy and hold and let the growing dividends roll in. Thank you so much for watching, I really appreciate it. If you like this video, please comment, hit the like button and subscribe for more financial and luxury content. I will see you guys in the next video. Bye bye!